All right, welcome to the first Minnesota Venture Builders webinar from the University of Minnesota's Technology Commercialization Venture Center. I'm Mary McCarthy, and this is the first or the second in a series of webinars that the Venture Builders program will be putting on. And the purpose of this webinar is to provide an overview of what the capitalization table is, how it works, and how professional investors, such as those joining me on the panel today, analyze the cap table and interpret the story that it tells. Thank you to Neela Molgard and Launch Minnesota for their support of Minnesota's entrepreneurs and this program, which is part of the Minnesota Venture Builders program overall. A few logistics notes. You'll notice that everybody is muted except for the panelists. Because this topic can be really complex, we're stripping it down to the basics for this particular webinar, and we plan to, in the future, potentially having a sort of Cap Table 102 webinar. So stay tuned for that. We are also not enabling the chat or Q&A portions of the Zoom functionality, and that is mostly just, again, to keep it simple and to keep it within an hour. Joining me today are 4 cap table and equity experts. Yeah. Or John Stavig, he's the program director at the University of Minnesota Gary S. Holmes Center for Entrepreneurship. Jodi Hubler, CEO and managing director of Lemhi Ventures and president and board director at Bind. Pamela York, founding member and general partner of Capita 3, and Cathy Connett, CEO and managing partner at Sofia Fund. I'll turn it over to John Stavig now to go through the cap table, how it works, and get us started then teeing up the 3 panelists. John, do you want to take over?
Great, thanks, Mary. Let me just share my screen here. Everybody see that okay?
Yep.
All right, so just want to go through some of the basics in terms of the cap table and hopefully set up the discussion amongst our investors. So briefly, in terms of the Holmes Center for Entrepreneurship, again, our mission is around inspiring, educating, and connecting the next generation of entrepreneurs. So we do this through a number of experiential classes and programs at the Carlson School. We work closely with the Venture Center on the MNCORE program, working on technology commercialization. We also opened a new innovation hub, and probably most of the business community is more familiar with our outreach programs in terms of the Minnesota Cup, Grow North. We'll be starting a new program with META this summer, funded by JP Morgan, that's Ascend Twin Cities. And we're also very involved in helping to spearhead the educational platform for Launch Minnesota, which is what we're here for today. So in terms of the cap tables, why do we want to talk about this? I guess, first off, this is an opportunity to really show, from a management perspective, to help align the incentives, have discussions around kind of what the goals are of the group, and help to motivate and structure in the incentives from the equity side. It's also an opportunity to share a positive story with the investors and really to be able to show the progress, again, reinforce the shared goals of the group and talk about how the incentives are in place. We won't probably have time to go deeply into all these, but there, a number of challenges that as you're putting the cap table forward, that the issues that arise around, making sure you're committed to letting go of control. If you're going to raise an institutional round, you're by definition going to be losing control. So making that decision before you go forward. We'll go through an example talking about, overemphasizing valuation up front, and some of the issues that can come up, particularly if there are down rounds later on, and we'll see that example. We'll also talk a little bit about the initial equity split amongst the founders, and structuring some incentive or option pools and making sure that we're hanging on to the equity and not getting caught in a position where we've lost some of the equity to initial founders or early management team, and structuring that appropriately and thoughtfully, but also at the same time, and I think Pam and others will share some examples of, trying to keep the cap table simple and clean. And I've unfortunately seen a number of examples from, former students and alumni where there's a lot of unnecessary complexity in there. And hopefully we'll have some time in terms of talking about some of the common issues around, protecting some of the early investors, and also, fundraising in a situation like we're addressing right now. A couple of quick resources that they're both books and blogs by Noam Wasserman, who's at Harvard, and then Brad Feld with the Foundry Group and Techstars. A couple of good resources on all these topics. So I'll walk through briefly an example in terms of, a small group of founders pooling together, what the initial cap table looks like, and kind of go step through step in terms of raising an initial $500,000 seed round, about a $3 million Series A, and then a couple of different scenarios in terms of fundraising after that, just to give you a high level feel. Obviously, there's a lot more detail, and I think the examples the investors will go through will share some of the more complexity, both at the early stages and as you go through. But these will highlight a couple of the major terms. So initially, in terms of formation, fairly straightforward in terms of setting up and hopefully paying for to get the cost basis in terms of the equity amongst and I would typically recommend in most structures there is a controlling shareholder as opposed to carving it up. We get a lot of particularly students or newer entrepreneurs who oftentimes will have 3 or 4 people, and carving it up equally is really not the best approach. And just to step out of it for a moment, just the whole founders equity split at the beginning is a whole separate topic we could probably have our own webinar around, but being thoughtful about what each individual is really bringing to the company, and are they contributing capital or time in the form of capital up front? Are they bringing relationships? Are they bringing technology or patents or critical capabilities? Not necessarily experience, but what are they bringing to the business? And then I think secondly, what are they going to contribute going forward? And really having a bias toward execution, that the value isn't in the idea, it's around the execution, and making sure the equity incentives are really in place and rewarding the people who are going to be there to grow the business. In talking through, as I mentioned before, around the vesting and the forfeiture and repurchase, and really having some healthy discussions up front around, what are the goals of the group in terms of holding time, in terms of exit and objectives, and putting a structure in place that's aligned with that. You can look at, and there's some people who argue for, dynamic models in terms of equity. I think by the time you're getting toward raising external capital, you probably don't want to do that. But early on, it's almost that dating period, and particularly if you're doing it remotely or there's some part-time time commitment, you might want to work through this a little while before you lock in on a fixed equity split. And I think in a lot of situations, it's going through and evaluating the scenarios. And I talk with founding teams of students that if you've got 3 or 4 students, I'll look at them and I say, I don't know which one of you it'll be, but one of you is going to get a great job opportunity. One of you is going to run off and get married, and one of you is going to do this. And how are you going to take care of that person? And think about, first off, if it's someone else, do you want to be fair to them and reward them for what they've done, but not necessarily give them a perpetual free ride? And then also think about if it's you, and structure it in a way that can be meaningful. And I think if you do that in advance, you can set up a system that's, fair to each of the founders coming in, and and the early employees, but doesn't create kind of the baggage behind. So again, the initial formation, we get 2 or more in terms of the founding team having an initial piece. Here's my plug for Pat Dillon and the SBIR program. If you're in a research area and have an opportunity for non-dilutive funding, you should absolutely go for it. And as you see the cap table as this goes through, if you can raise, in this case, $1 million, that puts you way ahead. It's non-dilutive. A lot of people wouldn't put that in the cap table. I would put it in there. Obviously, it doesn't have any shares to it. As we go forward, doing several $100,000 of could be a safe, could be some form of a convertible debt. And in this situation, I'm saying a convertible loan for $500,000 with a $5 million cap. Typically, it would have a discount of 20% or something like that. You have not yet issued any shares, but I think it's important for the founders to keep in mind, and certainly to alert any future investors that this is out there. They know they're going to issue at least 100,000 shares based on the cap, and potentially more based on what the next qualified round of financing is. So as we go forward to that, if we carry through the example, we go forward with the Series A round, $3 million round at an $8 million valuation. So you're giving up a little less than 30% of the company. Oftentimes, as the first institutional investor comes in, if there's not some type of management incentive pool, they will encourage that to be structured, partly to get that dilution out of the way before they come in, so they're not diluted by it, but generally as a good practice to look ahead and realize that, based on where the team is, they might size that in the 10 to 20% range, looking forward in terms of the new hires that they're going to need to make. So the founders at this point have gone from their 100% down to about 58% collectively. Continuing on with this robust scenario, company making strong progress. They get a $10 million Series B round with a pre-money valuation of $25 million. They're giving up, again, a little less than 30% of the company. Very healthy increase in terms of the price per share. Everything making strong progress. The founders are down to 42%, but obviously own a smaller piece of a much more valuable entity. And if you were to play it out in terms of assuming, again, a very strong, dream exit scenario, you can, based on the industry, if you're going into, some of the medical technology or things like that, add a zero in some of these numbers, and in other industries, maybe make it a little bit smaller, but, adjusting for a successful $100 million cash acquisition, starting to look at what the waterfall of payments would be. And in this scenario, I've shown a structure where both the Series A and the Series B preferred shares have a preference in terms of a participating preference, such that they get money first, they get their money back. So the $10 million from the Series B, and then the $3 million from the A, and then the rest of the group, they convert to common, and they split based on the common shares the remainder of the 87 million. So you can see in that situation, founders do extremely well. Again, this is the rosy scenario, no bumps, everything flies through. Obviously, a lot of other issues to include in there. And the preferred, the participating preferred, may or may not be in there. That's one of the points that's negotiable. You can see the founders lose about 6 points as a result of that. At this level, becomes less of an issue at a higher level, but kind of at these moderate levels, it does help to increase the ROI of the preferred investors. So the other scenario, and I think an important one to keep in mind as you go through and as you think about valuation and kind of the whole series of step-ups through each of the investment rounds, and not getting too aggressive, is looking at what a down round can result in. So we're back up where the founders started with 100%. They did the seed round. The management pool was in place. Series A came in, and things went sideways or backwards a little bit. They were able to put together a $5 million round, to keep the business moving, but it was at a significantly lower valuation. So the pre-money now is at $5.5 million, which is actually half the value of what the post-money was in the last round. So such that the price per share really has fallen in half. And in this situation, what I've assumed is that the Series A shareholder has dilution protection, which is another negotiable opportunity. What I'm showing here is kind of the extreme of a full ratchet, such that, because the price of this Series B is at $3.20 per share, basically half of what the Series A had been, that Series A investor gets their money, gets another equivalent, 470,000 shares to gross them up such that they're not diluted. So this is a very costly round. As you can see, they give up between giving up 1.5 million shares at a lower cost and then almost another 500,000 for the dilution protection. They're giving up 2 million shares, or about 55% of the company. So the founders go from a situation where they used to have something like 58% to where they're now owning a little more than 27% of the company, around a quarter of the company. So this is a costly situation. Thankfully, it happens earlier. If there were more shares outstanding, it could be even more punitive. So continue the example going forward. After the down round, the company gets back on track, is able to move forward with its $10 million round at a $25 million pre-money, just like before. So it gives up an additional 30% of the company, but obviously the founders are a lot more diluted than they were before. So they're down below 20%, still a very good outcome for them, but they've taken a huge hit as a result of the down round. So as we look at different exit scenarios after the down round, you can see that not only was there a little bit more money that came into the company, so there's some more preferences on the left, but the initial founders are now down to about 16% as opposed to a 36% in the first scenario. And you can also see that in terms of the ROI, in terms of the different groups, that the institutional investors in the A and B rounds are generally doing better. The seed round is starting to take a hit at this. And if we look at one more example where the acquisition price is 50 million, still a good outcome based on 18 million or 18.5 million of capital going in. So almost 3 times the money. But in this scenario, again, if there's the participating preferred, and if there is the dilution protection, the founder and CEO get diluted down to about 12% of the common equity, or of the 50 million, they get about 6 million of that. And also, interestingly, you can see the seed round that in this example came in as common alongside the founders. It made about $100,000 on its initial 500,000. And if the acquisition were down a little bit lower, if it were less than 45 million, the seed round wouldn't make any money, even though the Series A and Series B round would make a profit. So that's one of the scenarios in which some of the early investors, which oftentimes are friends, family, supporters, or associates of those groups, can get diluted down based on either the preferences or some of the dilution protection, particularly when there's a down round. So just to wrap it up in terms of overall lessons from this, as you use the money productively and expand the business and raise additional capital, and do that kind of progressively and hopefully avoiding some down rounds, dilution is a very good thing, right? And if you get the right investors in and increase the value, having a smaller piece of a much bigger pie is positive. I think the big things to watch out for in terms of making sure the founder's equity and the early individuals, that is being vested, that if they leave, there's a process for that, for the unvested piece to be forfeited and for the vested piece to be repurchased under some fair scenario. That if they worked for a period of time, they should get value for that, or at least a note or some form of compensation from the company. But it shouldn't be a sled that the company has to continue to pull along over a long period of time. In terms of the down rounds, they can be very punitive, and as the example showed, particularly for the early investors, certainly they hurt the founders, but oftentimes the institutional investors are always going to be making sure that the founders have enough equity to be highly incented, whereas they really don't have a lot of concerns in most cases, for the angel investors, and don't need them to be motivated. So I think one of the lessons of that, I think one of the common issues is around chasing high early valuations and setting up a really difficult process for them to continue to show steady increases in terms of the valuation. And also, and certainly in light of the current economic situations, companies looking at a scenario like this of making sure that they're managing the burn rate, that they're planning out, having enough capital, and preserving their options and not getting in a situation where they have to accept kind of more punitive terms or a down round. So hopefully they can ride it out if it's more of an economic or issue like we're going through now. And then also thinking about in terms of the rights that they'll be negotiating. It's not all about the price. There's a lot of fixation in terms of the value on the negotiation, but also thinking about, what preferences there are in terms of participation or liquidation, and also thinking about the dilution protection as well. So with that set up, I will turn it back over to Mary.
Pam, are you ready?
Sure. Okay, can you see my screen?
Yep, thank you.
Great. Hi, everybody. I am Pam York, and my firm is Capita 3. And we invest in early stage companies, pre-seed, seed stage, Series A, sometimes bridging to Series B. So we see a whole variety of information, not only the cap table, but pitch deck financials. You see a wide spectrum of preparedness in the financing process. Obviously, as companies get a little bit later, they're a bit more prepared, especially with things like the cap table. But one of the messages I wanted to deliver, first of all, I want to really underscore Jodi's message about having things very simple and easy to read. This maybe seems like a minor point, but what you're trying to do is really understand the company. And the harder it is to review the information and including the cap table, the longer it takes to get through the diligence process, the less likely you are to make an investment. And for me, I would say next to the pitch deck and the financial projections, the cap table is the single most important thing that I look at. And if done properly, it tells a very clear story of where the company is that you cannot see from the pitch deck or the financials. And so what I'm showing you here, I'm just focusing only on the portion of equity that's gone, that's what's called common. So this is common stock that the employees would have and other key contributors to the company. So John and Jodi both showed you more complex cap tables that involve investors, but I think if you can start with, if you're getting ready to prepare your own cap table or you have one, starting with clarity in just the company and its key advisors, and get that story right based on making a very simple cap table is a very powerful way to then move into a more complete cap table. So what are we looking at here? We're looking at how the equity is shared amongst the employees, the board members, the advisors, and then what are called warrants, which we'll explain. And then the remaining, what's called the equity pool, remaining equity that hasn't been allocated that could be allocated in the future to employees or other key contributors. And so this is a company that we invested in last fall. And some of the things that we looked for is, first of all, this company had just about $1 million in revenues in 2019, and they were moving towards $4 million in revenues in 2020. And of course, that's subject to current market conditions, but that's what they were projecting. So that's a little bit later than, say, a pre-seed or a seed stage company. And so commensurately, we would be looking for, is the company structured to deliver on those milestones, and what is the foundation of the company here initially? So you can see here, this company had two founders, a CEO founder and another founder, and the CEO founder had about 60% of the company, owned about 60% of the company, and the second founder owned about 10%. This is not uncommon, to have a single large ownership with one person. And as John was mentioning earlier, sometimes you can see 2, 3, 4 founders with a more even split. But in this case, it was one person who had an idea and then brought on another founder that really helped manifest that idea. And And then over time brought on KE stands for key employee. So you can see in technology, operations, customer service, a lot of technology and operations. This company's technology and operations heavy, which tells another, tells another piece of the story. This company was in digital health, so they obviously had to have quite a few employees really developing the technology solutions. So you can see with the equity split, so 60% for one founder, 10% for another, roughly 3% for several key employees, and then dropping down to 0.5% to 2%. This is not at all uncommon what you're seeing here, these distributions. So anybody that's at 0.5% or above, by key employee, we mean they would be very hard to replace in terms of what the company needs to deliver on, in the next year or so. And then you see other employees with much smaller amounts of equity. It's not that they're not important, they are. They just might have a skill that's easier to find in more than one person, whereas founders tend to have skills that are hard to replicate. So seeing this equity split, this is common, this isn't highly unusual, so that didn't raise any red flags there, except for that we found out that this founder was not with the company. So that would be one thing you would want to track down. Somebody has left the company with 10% of it. What does that mean? Turns out this was just someone who helped launch the company, had some good skills, wound up being an investor in the company. So there were no problems there. The other thing that we wanted to look for, given that this company had only raised money so far from convertible notes and was going to go into a Series A round of financing, at that stage, you want to really look to see, do they have the governance and the advisors in place to really help that company move to the next stage? And in this case, they had 4 board members in addition to the CEO. And so typically you would have 3 board members at a very early stage, 5 board members as you're moving into Series A. And they were all, this company is also in healthcare, so it's digital health and healthcare related company. So they had all of the board members were either investors and or key opinion leaders in healthcare. So, we looked very carefully at those people. They're compensated at what you would expect given their board positions, and they're people that are prepared to advise the company. And then also they had brought on a number of key advisors in healthcare with different levels of expertise in different sectors, and they're all compensated appropriately with equity. And again, these are all for this portion of the cap table, these are all grants or options. So these people are not investing money to receive this equity that's being granted to them, or they're given options to grants. And then finally, warrants. Another thing we look for is, did the company work with an accelerator? So you can see there was a nonprofit organization that was working with the company. They went through an accelerator, they went through another accelerator that had tech services. And then finally, they have an equity pool left over that can be invested or granted to other employees in the future. So this is what we would consider to be a very clean cap table, well distributed. And then maybe just 1 or 2 final points. Since this company was moving into quadrupling their sales, when you look at this, you don't see any sales personnel. And so one of the things that we really had to track down is, how are you making sales, and what is your plan to grow sales and bring on salespeople? Turned out the CEO was doing most of the sales herself, which is not uncommon for an early stage company. So we had to satisfy ourselves that that they were going to be able to bring on the sales team that would be required to help the company scale. So I mentioned already this founder had left the company. That's another thing that you have to track down, where is the equity, and ideally having it stay with the company. And so maybe I'll stop there. I'm not sure how much time has passed, but this is just kind of how we look at the cap table to really tell the story of where the company is and where they're going.
Great, that was clear, thank you. It's interesting to get several people explaining it because you get different angles with each presenter, so I really appreciate all of you. Cathy, you are next. I'll bring yours up here.
Okay. Okay. Thank you. Can everybody see that okay?
Yep.
I will make it. Okay, there we go. So I'm Cathy Connett, one of the 5 partners in the Sofia fund. We invest in women-led technology-based growth companies, actually running our second fund. I chosen as an example, I wanted to look at a cap table analysis with stacked convertible notes. One of the things that I was seeing, certainly pre-COVID, was more and more people doing, more and more people sometimes doing stacked convertible notes. So I wanted to do an analysis. This is a summary table of the analysis because I wanted to show the effect. So essentially this is, and it's a sanitized version of a real case, just so you know. So this was a situation where the company actually did 4 convertible notes followed by a Series A round. As you can see, very early on, raising small amounts of money. At the point before the first convertible note, the key founder owned about 60% of the company in common stock. They raised about $175,000 at $1.5 million, then had a second convertible note at $2 million, raised a larger round of $1.5 million at a valuation cap of $3 million, then did a convertible note of $900,000 at $4 million, and then raised $2 million at a pre-money valuation. And I guess I wanted to go through this analysis because here's a company that's raised $2.6 million on convertible notes and then did a qualified financing of $2 million. And a lot of people will talk about the advantage of convertible notes because you don't have to, you put a valuation cap on it, but you don't have to lock in the valuation. And so I wanted to compare several scenarios here so people could see what happens. So the first scenario, basically at the time that the Series A was raised, all of the convertible notes converted. And so, and again, they had all extended maturity, so there was no situation here where the notes had to convert prior to the raise. So they all converted, and the post-money valuation went from pre-money 8 million to 17 million. The common stock owners still had 47% of the equity. The other thing I assumed here was always maintaining a 12% option pool for the so you would have options to give to management. So the common stock ownership was 47%. The founder was half of that. The convertible debt ownership of the company as they converted was 41%, and the Series C ownership, or Series A, excuse me, typo there, was 12%. Part of looking at this was the valuations were fairly reasonable, but in terms of looking at getting the Series A round done, there was questions raised about raising the valuation cap on the notes because the post-money valuation at 17 million is really getting pretty high. So I looked to see the effect of that, and the post-money valuation goes to 16 million. Common stock still has 50%, so not significant change in the numbers. So this is all using convertible notes followed by a Series A round. I then took and looked at it and said, well, if the the convertible notes and managing the whole process of the convertible notes and getting approvals as different rounds went on, took a lot of time from this company that could have been invested in doing things with the company, but they spent a lot of time on financing. So I said, well, if we hadn't done the convertible notes and had literally done each of those rounds as equity and done an equity raise with the pre-money valuation being essentially the valuation cap, how does it change it? And as you can see, the ownership numbers don't change significantly. There's a change in the convertible debt ownership goes down. The Series C or Series A round has a higher ownership, but one of the important points is the $10 million post-money valuation. here's a company that's still fairly early and is raising 2 million and will have raised a total of 4.6 million, but a 10 million valuation going into their next round is probably a much more reasonable round expectation than a 16 or a 17 million. Just for grins, I did scenario D, which was more or less the same thing, but just simplified, did combine the first two notes into a smaller raise. And again, still comes out fairly reasonable. A lot of people think that with the convertible rounds, they're preserving more valuation for the owners. But I would argue the case that they're actually taking on more headaches, not preserving as much. And actually, you can see the option shares at 12% actually are higher the number of shares that you have to be able to distribute to management. So I guess the key takeaway I would say from this analysis is that sometimes it is better to go ahead and do the equity rounds. It's much simpler, as both Pam and Jodi have said. Having a clean cap table, a cap table that is simple and easy to follow is much better for subsequent investors. And also what you're essentially done is you've artificially, by using the convertible, think about those first note holders, they're essentially getting an interest rate that is more or less being guaranteed over time. So their share of the company is continually rising, which is driving up the post money. So it's not always a good deal to go the convertible note round. You actually sometimes are better off with the debt round, or excuse me, the equity round. I think what all of these points illustrate, Jodi's example and Pam's, as well as John's, it is extremely important to understand at the beginning to play out some of these scenarios. Yes, there is some complexity in doing the calculations, but it really is important for you to understand the trade-offs and understanding some of the pros and cons of what can happen with different financing scenarios. A lot of entrepreneurs start out very early thinking about strategy and business strategy and marketing strategy and technology strategy, and actually understand financial strategy, because the financial strategy can be just as important in determining whether you're successful or not. Because if you misplay it early and drive up valuations, or as John gave the example of down rounds, etc., these can have major ramifications, and you need to think about at least the potential forks in the road and understand some of the decisions and how they might affect your financing down in future rounds. Thank you, Mary.
Great. So I thought I'd give us just a few minutes for any of you to react to anybody else's presentation if you had any other thoughts before we jump into the Q&A.
I'd have a question for each of the investors. Looking at a company maybe that's the stage that Pam shared, where it's the team is largely in place and you've got common and there aren't a lot of institutional investors in yet. What do you look at in terms of, what do they currently have in place in terms of a vesting program, and what would you insist upon in terms of either revesting or coming into a situation like that as an investor?
I know from a Lemhi perspective, we, and all have mentioned it, we would look for, we really try and follow a form following function. So while there's the general rule around a 15%, some 20%, 12% spread of an option pool, you're really looking at that. Are they being mindful and thoughtful, and that there's a thread throughout the entire pitch, close, that what they're saying their use of proceeds are, what they're building as the logic for why they're raising what they're raising, and that then follows through to the cap table. We really would then look to an alignment of incentivizing not only those common holders as they look to move on in whatever executive roles. But then we're wanting to re-enroll, or what you might hear is re-up, that leadership team in a way that also gives them an opportunity to share in the go forward value of the company. And so I'll stop on my part, knowing that keep going too much to take everybody else's thunder, but I would say that 15 to 20%, 12 to 20% of an option pool that is earmarked specifically tied back to the use of proceeds for the hiring to fill through that series of financing.
I'll just jump in here, and I'll speak to vesting schedule. So if anyone doesn't know what a vesting schedule is, it's this idea when you receive equity, you may not get it all up front. You might receive it over time, portions of it over time. A typical vesting schedule could be between 3 and 5 years, depending on the company. And so for the example that I gave, the company was several years old. They'd already raised $10 million, in convertible note rounds, and they were going into a Series A. And so with a company that's several years old like that, the founders might expect to already be vested, but you don't want to put money into them and have them be able to walk away from the company with all of their equity. So you redo the vesting, you kind of restart them, and you don't start them back at zero, because that's disincentivizing for the founders, but maybe give them a 2-year vesting schedule in order to make sure they stay with the company and deliver on the value proposition that you've invested in.
I guess just to add to that, I totally agree with the need to, investors are basically looking to incentivize the management to be successful, because if they're successful, then we're going to be successful. So I totally agree with having a thoughtful, strategic option pool that can incent and motivate people. I think one of the questions that sometimes comes up that looking at Pam's example was interesting to me, because I guess I look at it, sometimes the question comes up around board positions and compensation for board people. And I guess generally thinking about that, I don't really like to see equity grants for board roles. Options I think are fine, but particularly at an early stage, I think some people feel like they have to compensate board members, whether they're independent or not. And I guess, again, I look to what is their role and what's the value they add. And I think options or vesting of options for the board members is probably more effective than stock grants particularly in an early stage company.
Great. Thanks, Cathy. I'll move on to the 2 questions that were submitted before. How do we maintain enough equity for our seed funders, our friends and family, so that they get a reasonable return rather than being fully diluted later with later rounds? Anybody want to take that one?
I'm happy to start out on that one. I think the issue is, if you think about the way you ask the question about not getting diluted and being able to make money. And I think that sometimes those are cross purposes. We as investors are really looking to companies that will grow to be significant. It's back to this large piece of a small pie or a small piece of a big pie. We're really looking to see very large opportunities where everybody can get fairly compensated for their effort. And as I said earlier, particularly the entrepreneurs and management. So sometimes by trying to hold things too close and keep that pie too small, yes, you can own 60% of a very small pie, or you can own 20% of a very large pie. And I think sometimes you have to think of it in that perspective. And it's not about the percentages, but it's what is the opportunity that you can gain from the much bigger pie. And usually that bigger pie requires investment, and the entrepreneur may not have access to that. So the compensation to the being able to get that money, the compensation for the investor is having a piece of the pie.
Got it. Any other comments, or did we cover it well enough?
As I tried to highlight in my example, I think, not focusing just on the valuation, but also, understanding what other rights they're giving up in subsequent rounds, I think can help protect some of those early stage investors. Or, you look at successful folks like Phil Soren or that, or, I think a lot of my former students who've had, who really look out for those early investors and make it a point in terms of the negotiations, to try and do well by them. And that doesn't mean they're not going to get diluted, and hopefully they get diluted in a good way toward a bigger pie. But oftentimes it's trying to give them a voice at the table, whether that's through the management team or through maybe an institutional investor who's part of an angel round or something like that.
Yeah, Mary, I'll come behind John's really quickly because I think Cathy covered the philosophical, and without the benefit of an audience that we can really nuance that question, I'm going to focus on the how aspect of it. And that how question, John, I really want to emphasize John's point in that if you don't have the benefit of being one of his students, find a good advisor. And that deck at the very beginning. So for those of you that are watching this, rewind and go back to the beginning and see the number of advisors, see the number of folks even that are on this panel that would be willing to meet with an entrepreneur that has that friends and family round and help think about the wisdom of setting up even that initial cap table, knowing that this is a math equation, right? That the dilution that we're talking about is just taking a percentage from prior percentages. So you want to be very thoughtful. The how is you want to be doing good math at the beginning with a lot of clarity and a lot of specificity so that you're in a position to have good discussions with those investors who, while you've seen one company and you're establishing one cap table, and that might be your own, these investors have seen anywhere from, thousands of them. And so that asynchronous information means that right at the beginning, you want to get some good wisdom and some good counsel to help you think about the math equation that you're setting up.
Good counsel. All right, the second question that came in is, when determining valuations, what discount rate should be used and what do we need to do to achieve a step towards a lower discount rate? Any thoughts?
Yeah.
Can we clarify what is meant by discount rate in this case? Do we know?
She didn't say specifically, perhaps net present value discount?
I'm assuming a discount I was thinking from a convertible note to a qualified financing round.
Gotcha.
I guess, to me, that's an interesting question for prior times. I guess I would say that I think we have to also talk a little bit about what's happening with the COVID crisis and what that's going to do to financing, because I think that in the past few years, it's been a somewhat entrepreneurial friendly market with investors. Investors have, it's been more both sides kind of equal in the negotiations. I think as we go forward, I think some companies are going to have a fair amount of difficulty raising money from investors. And I think, and one of the concerns I have, particularly from larger investors, is that the terms are going to get more onerous. There's a lot of money in very large funds that have a potential to take advantage of a situation. The angel market is still trying to sort itself out a little bit in terms of if people are angels or usually have some of their money coming from the stock market as the stock market goes down. Some angels are saying, I'm not going to be doing a lot of investing until the stock market comes back. So I think it's some of the larger funds that are going to be controlling the deals. And for example, the marketplace in the past has been a one-time preference on liquidation, and not necessarily participating. John's example gave an example of participating preferred. I'm concerned that that's going to become more the norm. It's going to become investors putting much stronger terms in, valuations potentially being lower. So I think that it's, an entrepreneur, I would be concerned about finding money and finding money at terms that are acceptable, that they can live with. Back to Jodi talking about thinking through all the alternatives. I think it is going to be a difficult time, and it's going to be, some investors are going to really put the screw down.
Well, and that's, we talk, one of our managing partners talks about the difference between, a hawk and a dove during these periods of time. And so from an entrepreneur perspective, where we're seeing discounts starting to be applied is companies who, caught themselves for whatever reason, and there are a slew of scenarios, both good and bad, where they need bridge financing during what they're viewing as potentially this kind of trough, right? That they might have been almost at the cusp of closing something in February, March hit us, and now we're wondering how long this is going to go. And so we're seeing some bridge financings come in with discounts to the next round. Standard sometimes is 20%. We're seeing as much as 40%. That puts people in some very interesting scenarios. So one of the things we would advise is ways to work yourself out of that, whether that's bookings, sales, size of raise, that there are other ways that the discount actually moves and brings you into some optionality, so that you're not simply just beholden to a simple math equation. If this, then this. If you raise, we get a discount. But if we raise and raise so much, we also get an opportunity to shift that discount differently, in essence, that you're deriving a value for the bridge loan in a way that can improve the discount.
I'll just jump in quickly and just say you can find in venture capital discounted cash flow analyses for valuations, but they don't really apply to early stage companies. The best way you can figure out what is the right valuation, we're using discount in different ways. So in that case, discounted cash flow analysis is not really applicable to what we're talking about here. We would recommend you do comparables analysis, and you can get those from PitchBook, Crunchbase. You can search, you can do Google searches on what are, seed stage valuations in healthcare, what are discounts to caps, discounts on convertible notes. You can get that comparable information from, it's all market. It's all market. There's no calculation per se, or I shouldn't say no, but typically not done by calculation. And then in terms of discount, both Cathy and Jodi were mentioning discounts into the next round. Convertible notes often come with a discount, so you are benefiting the investors that come in early versus the ones that come in later. And we've seen everything from 5 to 20% over the past year, but as Jodi indicated, you can expect some of those numbers to be higher given the current circumstances.
Great, thanks. Well, just to wrap up, would you give like 1 or 2 tips for entrepreneurs on how to create a cap table? Like, what are a couple things that they should definitely keep in mind as they're drafting it up?
Well, I'll just jump in and say, everyone's mentioned getting an advisor. If any of this is confusing to you, it's okay. This is a very confusing topic. Doing cap tables is really a challenge. And so get a good advisor. First of all, read a book or 2 and get a good advisor if you have to put together a cap table or revise your cap table. And you've heard the word scenario analysis. There is no substitute for doing the scenario from start to exit with various things that could happen to you, as many people have shown here today, so that you understand the pathway. There's no substitute for that. It's time consuming, but it's well worth the effort. Now,
I would do it for those of you who absolutely listen to Pam, read. And then for those of you who need the street smart, just get her done. Cooley Go, so the law firm Cooley Go has downloadable Excel scenario sheets that do a round and then a post, and you can download their Excel models and have them kind of pre-fit. Doesn't mean they're prefabbed, but there's at least an example. So Cooley Go and download their Excel models.
Thanks, Jodi.
And I would just comment back to the fact that understanding the various scenarios and understanding this is as important a part of your strategy can't be emphasized enough, because it can make all the difference.
Great.
and I would just say lastly, and I know we touched on it a little bit, but not trying to be too clever at the beginning in terms of the structure. And I think if you start creating, these Zuckerberg controlling non-dilutive type shares, it just creates a firestorm eventually. So keeping it very simple, and I think using this tool as an opportunity for the founding team to really have a conversation about what their goals are, and then structuring the rest of it in alignment with that.
Thanks, John. Well, we're out of time. Thanks everyone for joining us. I'd like to also thank Tom Brady of Clifton Larson Allen, who was an original sponsor of this months ago before COVID came. And so thank you, Tom. And we'll get you in on other presentations in the future. This webinar is being recorded, and I will send out the link. So if any of you missed the first few minutes because of the confusion over which Zoom room we were in, you'll be able to catch up at that time. So thank you, John, Cathy, Pam, and Jodi. You're all awesome. And thank you so much for supporting the community and the University of Minnesota.
Absolutely.